I've heard, and mainly because I'm watching you, but I've heard that there are properties that are on the marketplace for 80 cents on the dollar that are otherwise in really good shape. Now, anybody who's just common sense, that doesn't sound right. Properties are trading at that kind of distress level that otherwise seem to have good fundamentals. Seems like there's something wrong here. And I think the biggest problem that most people have when they hear something like that is, okay, it's got to be just a one off because, the stock market is soaring and everybody in the mainstream is so optimistic. How can we have a situation where it really seems like there's not just some distress in the marketplace, because I think people realize commercial real estate's been under pressure for a while, but doesn't it seem like maybe from your position, things are changing a little bit further where, before it was extend and pretend everything frozen, maybe starting to break free?
Well, okay. Yeah, there's three things that I think are really important that are happening across the board for pretty much all commercial real estate. The first thing is there's softness on the rent, right? Like, so when rates were really low, people started to build. And so we have this supply issue. So excess supply, more choices, rent softness. So that's one. Also, that turns into concessions and other things. And this is market to market. There are some markets that are doing really well, some markets that are really in trouble. The other one is what is least looked at are the operating expenses. So it's no surprise that utilities are up and property insurance has been all over the news and certainly property taxes. So when you have income going down or flat or negative, let's say, and expenses going up, that means your net operating income is suffering. So that would be one thing. And then, of course, what everybody's following mostly is interest rates. So when interest rates go up on floating debt, let's say, then the mortgage payment also goes up. And when a mortgage payment goes up, less cash flow. So you have all three of those things happening. Now, if you have fixed rate debt, you're actually pretty good. You can kind of weather the storm. However, we have loan maturities. So loans, when they mature, they're resetting. So I have several of those, dealt with those this year. We have two more coming up in the spring of 2027, where our rates were in the fours. Today, we're definitely going to be in the fives. So that means exact same property, same tenant, same income, same expenses, but now my mortgage payment's going to go up. So when the mortgage payment goes up, cash flow goes down on that exact same property. And so what you have is lenders that are sizing these assets based on lower income, higher expenses, and then this new mortgage payment. And all that it repriced really everybody. It's not a one-off issue. The whole market was repriced as a result of this.
Have you seen maybe more changes as maybe more people who are willing to sell and willing to, because I think that was the biggest defining feature after the initial crack up was like, hey, let's just hang in there for a year, maybe two, things turn around and it moves into the right direction. The numbers start to work a little bit better. The economy picks up and the rent side goes up. Because what you're saying is these property owners are being squeezed from both sides. They can't get the rents that they want at the same time their costs are going up. So the question I have, and I think the question a lot of people would ask is from your perspective, are you seeing people are starting to throw in the towel? Because it was, hey, let's just hang in there. Let's hang in there. And now they're saying we hung in there and it didn't really work out for us. So let's see what price we can get and get the hell out before the numbers get too bad in our direction.
Well, okay. So actually, it's an interesting question. Not necessarily. If you have one asset with floating rate debt, for sure you're throwing in the towel, right? Because there's no hope, right, on the future, on will rates go down? Will they ever be what I thought they were going to be? And how long is this going to last? And more than likely, they funded that asset for a while. In many situations, Jeff, as you know, like myself, we have a number of assets, 40, 50, 60 assets, let's say, where some of them are doing extremely well, and you might have a few that aren't, right? And so you're funding these, and if you have a loan maturity, of course, you're going to be in a situation where you're probably going to list that asset, and hopefully you have enough equity to return that back to people that are investors, and certainly enough to cover the debt. It's not really, if I have an asset and I don't have a loan maturity for 3 or 4 or 5 years, there's absolutely no way that I'm selling today. Because it's like, well, it's probably cash flowing because it has fixed rate debt on it. Yes, my expenses are definitely up. And yes, it's harder to get tenants, but that's the world I'm in. I'm used to managing that stuff. That's not new. And so, what I would be waiting for is for the market to firm up and, all of a sudden the supply to kind of dwindle down and then the demand to come back. And when demand comes back, then prices will go up. So if I have something that's got a few years left on it, absolutely positively not, I'm not going to sell it. If I have something that's 1 year out, maybe or imminent today, maybe got floater, for sure, I'm looking at a variety of exits.
So basically what you're saying is it's a reset of fundamental expectations after things being way too high back in, 21 and 22. Now we're getting a little bit more realistic. As you said, property owners are becoming a little bit more attuned to the reality of the world that we're living in and trying to do the best that they can, which I think makes a whole lot of sense. So then the other wild card then would be the financing side. Getting any signs that the banks are balking a little bit, or are they just still willing to fund and maybe, to finance some bridge financing or fund some bridge financing? Is there tightening credit standards? Is there anything that suggests maybe there's some frictions building in the financing side of the equation?
Oh, for sure. So the tightening and all that already happened, right? Like this is not new information for lenders, debt funds, anything like that. They've been watching.
It's just new information for the public who've been.
Yeah. Well,
this is great. The stock market's booming.
Yeah, exactly. I know one of the things that we watch is what's the debt service coverage. And just to be simply discuss how that works, if your net operating income is $100,000 and your debt payment is $100,000, you're in trouble, right? I mean, it's 100% of your cash flow is servicing your debt. So that's called the debt service coverage, or that's what they watch. So obviously they want that at, let's say, 140, 150,000 of NOI with a $100,000 debt payment. That means you've got 30, 40, $50,000 of cash flow. So they watch this debt service coverage. So the debt service coverages have been on everybody's watch list for a long time. And that's really what people need to be looking at. And there's many, Jeff, where you have debt service coverage well under 1, like 0.6, 0.7, which means that the asset is actually worth 60, 70 cents, like we kind of started this on the dollar. And so there's a variety of issues that happen when the mortgage payment is more than the NOI. So in other words, that money has to come from somewhere because the lender is going to want their payment. So typically that's being funded by someone. And if it's not, you're in default. But the one thing that's really interesting, Jeff, and this started happening a couple of years ago, is if you're supposed to be putting money into the project for regular maintenance, the painting and the parking lots and the landscape and the roofs and the interiors and all that kind of stuff. But when all your money is actually moving toward the mortgage payment and maybe even negative, that stops. And so what we're starting to see is this huge rise of deferred maintenance on assets because of that. And so what you have is some assets, and this is all predicated on primarily the debt. So you have assets where people just don't have the money to put back into them, so they're deteriorating right before your eyes. And then you have other assets that are just fine right next door because they have a 3.5% fixed rate mortgage that's not due for another 3 or 4 years, if that makes sense.
Yeah. So the question then is now a good time to start looking for bargains, or are you waiting a little bit for the cycle to continue to accumulate discounted properties? From the buyer's perspective, is it starting to be a buyer's market where, you can get some bargains out there that make sense, assuming you can cover the cost of deferred maintenance? Because that's going to come out of the price, right? I mean, you're not going to go out of pocket for that. So you're going to ask for a discount for, to be able to put the maintenance in, or, catch maintenance up where it goes. But from your perspective, is it look like maybe it's starting to becoming time to buy, or are we still too early for that, something like that?
It's 100% time to look, 100% time to get your dry powder together, for sure. Not necessarily the time to strike or act or buy, because a lot of that is predicated on the situation from the seller or the lender in this particular case. For examples, if you have a brand new Class A building, you personally, let's say you built this beautiful building at 200 units at $400,000 a unit, and and that's what your costs were. That property today is probably worth $250, $275 a unit. So you're not in a position to sell, and anybody knows that that property is going to be priced significantly below what it costs to build. And so the equity's gone for sure. And you might be actually negotiating with the debt. So if I'm dealing with you, you're obviously trying to sell and you're trying to cover your debt. And you're maybe even trying to get a little bit of equity out of it, but the market bears what the market bears. Now, let me reverse that. There are lots of situations where a lender has actually taken back an asset and it's sitting on their books. And so the person who used to own it is long gone. The equity's long gone. And now the lender is actually trying to figure out what to do with that asset. And again, the market again is pricing it based on the market is. And so how does it price itself? What's the occupancy? What's the expenses? What is the interest rate? And in a lot of cases, Jeff, they're not even financeable.